When it comes to building wealth, two options dominate the conversation: real estate and stocks. But which one is actually better for growing your money? In this video, we're breaking down the pros, cons, risks, and rewards of investing in both, helping you figure out which path fits your goals, lifestyle, and long-term vision. Before we dive into the numbers and strategies, make sure to like, subscribe, and tap that notification bell so you don't miss any of our deep dives into smart investing. Let's compare real estate versus stocks and see which one truly wins. Historical returns and performance. When comparing long-term performance, stocks have historically delivered higher average returns than real estate. The S&P 500 has averaged approximately 10% annual returns over the past century, while real estate has typically returned around 3 to 4% annually when adjusted for inflation. However, these numbers don't tell the complete story. Real estate returns often exclude the benefits of leverage, rental income, and tax advantages. When you factor in these elements, real estate can become significantly more competitive. A property purchased with a 20% down payment effectively gives you 5-to-1 leverage, meaning a 4% property appreciation translates to a 20% return on your initial investment. Stock market returns, while higher on average, come with much greater volatility. The market can swing dramatically in short periods, with bear markets potentially lasting years. Real estate, conversely, tends to be more stable and less prone to dramatic value fluctuations, though it's not immune to market downturns, as seen in 2008. Barriers to entry and accessibility. Stocks offer unmatched accessibility for beginning investors. You can start investing with as little as $1 through fractional shares, making it possible for anyone to begin building wealth immediately. Online brokerages have eliminated most fees, and you can diversify across thousands of companies with a single exchange-traded fund purchase. Real estate requires substantial upfront capital. Even with favorable lending terms, you'll need a down payment, closing costs, inspection fees, and reserves for maintenance. This barrier typically means you need $50,000 to $100,000 to get started in most markets, though house hacking and real estate investment trusts can lower these requirements. The learning curve also differs significantly. Stock investing can be as simple as buying index funds and holding long-term. Real estate demands knowledge of local markets, property evaluation, financing options, tenant management, and maintenance issues. This complexity can be overwhelming for beginners, but also creates opportunities for those willing to develop expertise. Liquidity and flexibility. Stocks provide exceptional liquidity. You can sell your holdings within seconds during market hours and access your money within days. This flexibility is crucial for emergency funds or when investment opportunities arise. You can also easily rebalance your portfolio or change investment strategies without significant transaction costs. Real estate is inherently illiquid. Selling a property can take months, involves substantial transaction costs, typically 6 to 10% of the sale price, and timing depends on market conditions. This illiquidity can be problematic if you need quick access to capital, but it also prevents emotional decision-making during market volatility. The illiquidity of real estate does have psychological benefits. You can't check your property value minute by minute like stock prices, reducing the temptation to make impulsive decisions based on short-term market movements. This forced patience often leads to better long-term outcomes. Income generation potential. Stocks can provide income through dividends, but dividend yields on quality companies typically range from 1 to 4% annually. While some stocks offer higher yields, they often come with increased risk. Dividend growth over time can provide inflation protection, but immediate income is generally modest. Real estate excels at generating current income through rental payments. Well-chosen rental properties can provide 8 to 12% annual cash flow, with the potential for rent increases over time. This income can cover living expenses, making real estate attractive for those seeking financial independence or retirement income. The income from real estate requires active management unless you hire a property management company. You'll deal with tenant issues, maintenance requests, vacancy periods, and collection problems. Stock dividends arrive automatically without any effort on your part. Tax implications and benefits. Real estate offers superior tax advantages for most investors. Rental income benefits from depreciation deductions, which can shelter cash flow from taxes. Property taxes, mortgage interest, maintenance costs, and professional fees are all deductible. The 1031 exchange allows you to defer capital gains taxes by reinvesting proceeds into similar properties. Stock investments are subject to capital gains taxes when sold, though long-term holdings over 1 year qualify for preferential tax rates. Dividends receive favorable tax treatment in most cases. However, you can't depreciate stock investments or deduct associated costs beyond investment management fees. Risk factors and diversification. Stock market investing offers easy diversification across industries, company sizes, and geographic regions. A single index fund can provide exposure to thousands of companies, reducing single stock risk. However, systematic risk affects all stocks during market downturns, and diversification doesn't eliminate volatility. Real estate concentration risk is significant if you own individual properties. A single property represents a large portion of your wealth, and local market conditions, natural disasters, or problem tenants can dramatically impact returns. Geographic diversification requires substantial capital or investment in real estate investment trusts. Time commitment and management. Stock investing can be entirely passive through index funds, requiring minimal time commitment beyond initial research and occasional rebalancing. Even active stock picking requires only a few hours per week for most investors. This passive approach allows you to focus on your primary career while building wealth. Real estate demands significant time investment, especially for direct property ownership. You'll spend time finding properties, managing tenants, coordinating repairs, and handling administrative tasks. Many investors underestimate this time commitment, which can make real estate feel like a second job. Market timing and economic cycles. Both real estate and stocks are affected by economic cycles, but they don't always move in tandem. Real estate markets tend to be more localized and can remain strong even when national markets struggle. Interest rates significantly impact both investments, but real estate is particularly sensitive to borrowing costs. Stock markets are more efficient at pricing information, making timing the market extremely difficult. Real estate markets move more slowly, potentially offering opportunities for informed investors to find undervalued properties. However, this efficiency gap is narrowing as real estate becomes more data-driven. And there you have it. Real estate offers control and cash flow, while stocks bring flexibility and compound growth. The best choice? It depends on you, your risk tolerance, time horizon, and how hands-on you want to be. If this helped you see things more clearly, hit that like button, drop your investing style in the comments, and subscribe for more breakdowns on how to grow your money wisely. And don't forget to hit that notification bell, because smart money moves start with staying informed. Until next time, invest with intention and build the future that works for you.